Remember just a couple of years back, it felt like SPACs were everywhere. They were the hottest thing on Wall Street. And I mean, celebrities, sports stars, tech gurus, everybody seemed to have one. They were pitched as this amazing, new, super fast way for exciting companies to go public, and for regular investors, people like you and me, to get in on the ground floor. But then, well, the bubble burst, and it left behind this trail of financial destruction. So today, we're going to dive in and figure out what on earth happened. First, just look at this number. Between 2020 and 2021, right at the peak of the frenzy, SPACs raised a truly staggering $163 billion. That is an absolute tidal wave of cash pouring into these things, these so-called blank check companies. The promise was so simple. Give us your money now, and trust us, we'll go find the next big thing for you.
But here's the brutal reality check. By mid-2025, the companies that actually went public through one of these SPAC deals were down, on average, a whopping 75% from their initial price. Now, let's be clear. This isn't just a normal market dip. This is one of the most consistent, predictable patterns of wealth destruction we've seen in modern finance.
Which, of course, brings us to the central question we're tackling today. Where did all that money go? I mean, $163 billion doesn't just, vanish into thin air. It was transferred. And to understand how and to who, we need to pop the hood and look at the mechanics of the SPAC machine itself.
So yeah, to find the money, we first have to understand the machine. On the surface, a SPAC might seem pretty straightforward, but its structure has all these layers of complexity, and those layers are absolutely crucial for understanding why things went so wrong for so many.
So at its absolute core, a SPAC is really just a publicly traded shell company. It has no operations, no products, no employees, just a big bank account full of cash that it raised from an IPO. Its entire reason for existing is to go on a hunt for a private company, merge with it, and boom, take it public. Simple enough, right? Well, as they say, the devil is always in the details.
And here's the typical life cycle of one of these things. First, you have the sponsors, the insiders, who create the company and buy what are called founder shares for basically next to nothing. Then it goes public in an IPO, selling units to investors for $10 each. With all that cash sitting in the bank, the sponsors then go on the hunt for a private company to buy. And finally, they propose a deal, and the shareholders get to vote on it. That final step, the merger, is what they call the D-SPAC.
Now this brings us to what is arguably the single most important part of this whole structure, the promote. So, for a tiny initial investment, sometimes as little as 25 grand, the sponsors automatically get to own 20% of the entire company. This is their big reward for making a deal happen. And honestly, it is the key to understanding where all the money went.
And that promote leads us directly to the fundamental, structural flaw of the entire SPAC model. It's a flaw that is baked into the architecture from day one, and it creates this massive, glaring conflict of interest between the people running the show and the people who are actually funding it.
And this slide just illustrates the problem perfectly. Just look at the two columns here. For a SPAC sponsor, the one who gets that 20% promote, their break-even point is pretty much zero. As long as a deal happens, literally any deal, their shares are suddenly worth millions. But for you, the public shareholder who paid $10 a share, you only make money if the new merged company's stock goes above $10. This creates a gigantic incentive gap. For the sponsor, a bad deal is infinitely better than no deal at all. For you, it's the exact opposite.
So the bottom line is this. The system isn't designed to find good deals. It's designed to complete deals. If the SPAC fails to find a company to merge with and has to liquidate, that sponsor's 20% promote is completely worthless. They lose everything. So you can imagine, this creates an absolutely overwhelming pressure to push any deal across the finish line, no matter how bad it is for shareholders.
And let's talk about dilution for a second. Because of that 20% sponsor promote, the $10 in cash you invested per share, it's not actually worth $10 of a real company. Right off the bat, that sponsor stake dilutes the cash value of your share down to about $8.33, and that's before a single other fee is paid. The value is literally leaking out before they've even picked a company.
And believe me, the promote is just the beginning. As you can see here, you have all these different layers chipping away at shareholder value. The promote is obviously the biggest piece of the pie, but you've also got warrants, which are kind of like bonus shares given to early investors, huge fees for the investment banks, and all sorts of other special financing deals. Every single one of them just dilutes the value for the average person even more.
Okay, so if the structure is so clearly bad for regular investors, who's actually winning this game? Well, the answer is what they call the smart money. We're talking sophisticated investors like hedge funds who figured out a playbook to make nearly risk-free profits. Let's break down how they do it. So here's how the arbitrage works. It's actually pretty clever. A hedge fund buys the SPAC units at around $10. Now, when a merger is announced, they vote yes to make sure the deal goes through, which helps the sponsor. But then, and this is the absolute key, they exercise their right to redeem their shares. They get their $10 in cash right back. But here's the genius part. They get to keep the warrants that came with their original units. So they get all their money back, plus a free lottery ticket on the new company's stock. It's a no-lose situation for them.
Let's be crystal clear about what's happening here. This isn't just some clever strategy, it is a direct transfer of wealth. The money isn't just lost. It moves directly from the pockets of retail investors, the ones who hold on through the merger, and into the pockets of the sponsors getting their promote and the hedge funds playing this arbitrage game. It's a zero-sum game, and retail investors are systematically set up to be on the losing side.
And I mean, the data is just undeniable. This chart shows the brutal reality. While traditional IPOs and the broader market delivered solid positive returns, post-merger SPACs have systematically underperformed, and not by a little, but by a catastrophic amount. While other investments were creating wealth, the SPAC structure was, on average, just destroying it.
So, given everything we've just seen, how should a regular investor even approach this space? Because this isn't just a history lesson, right? There are real, practical takeaways for anyone trying to navigate the market today.
Okay, here are 4 huge red flags to look out for. First, be really wary of sponsors you've never heard of. They have nothing to lose. Second, avoid companies with zero revenue that are just selling you a story based on wild, crazy projections 5 or 10 years out. Third, if you see a deal where over 70% of the shareholders redeemed their cash, that's the smart money telling you to run for the hills. And finally, if the business plan is stuffed with buzzwords but you can't actually figure out what they do, just pass.
Now, to be fair, regulators have stepped in. The SEC has introduced new rules for better disclosures to make SPACs more accountable. And that's a good step. But it is so important to understand that these reforms, while they're helpful, they don't change the core structural flaw. That fundamental misalignment of incentives between sponsors and shareholders is still there.
After the big crash, the market went quiet, but it never really died. As this timeline shows, new SPACs started popping up again in 2024. Insiders are even calling this new wave SPAC 4.0, and they claim they've learned their lessons from the last time around. The real question is this a genuinely improved, safer model, or is it just the beginning of another dangerous cycle? Which, of course, all leads to the one question that really truly matters for anyone watching. Should you ever actually invest in one of these things?
And look, based on all the evidence we've seen, for the vast majority of regular investors, the answer has to be a pretty clear no. The structural flaws, the massive dilution, the huge incentive gaps, it all means the game is fundamentally rigged. The system is just not designed to benefit you, it's designed to benefit the insiders at your expense.
To put it as bluntly as possible, one source we reviewed described the situation perfectly. In the SPAC casino, the house always wins, and you're not the house, you're the mark at the table. It's a pretty powerful warning to keep in mind. Which leaves us with a final and maybe more crucial question. SPACs were sold to the public as a brilliant financial innovation, but their story really forces us to ask, in the world of finance, does innovation always mean progress? And if it does, well, progress for whom?